Hello, my dear students. This is Accounting 3. I'm Miss Tania Poveda. Welcome. Remember to download this information on your computer so you can watch it later or print it or whatever you need to study later. Okay? So don't forget to download the information. You are going to receive this PowerPoint presentation and the lesson activities, so save that information too. Today we're going to talk about personal finance. Any idea what personal finance is? Probably you recognize this. It's a way sometimes we save money. But let's start with the definition of personal finance. So personal finance is the process of managing individual finances. It can help anyone to know how to save money for financial future, to spend money wisely, to budget money properly, and to accumulate money. Just as we see in this picture, how we save money, how we accumulate money. Okay? But why we call it personal finance? Because it's what you do as a person, what you do at home or maybe in a bank, but you do it as a natural person, not as an organization, not as a company, but as a natural person. Okay, so here on this video, we are going to know some definitions about how to save money maybe in the bank, like traditional banking, how to manage money in new ways banking, and also almost in the end, I'm going to give you a recommendation how to save money right now or in the future. Let's continue. When talking about personal finance, we also talk about traditional banking. So here it is the case of Lisa, and she says that she has an account at her local branch of one of the big street banks. Okay, so there is a big bank and she saves the money in a local branch. She said that she has a current account, current, not savings, current account for writing checks, paying by debit card, and paying bills. It's a joint account with her husband. Okay, so they both together have the account. Normally, they are in black. Black means that everything is good. But sometimes we spend more money than we have in the account, and we go into the red. So red is not good. Red numbers means that you are doing something wrong there. You are spending more money than the money you actually have. This overdraft is agreed by the bank up to a maximum of £500. This is not dollars, this is pounds. But we pay quite a high interest rate on it. Okay, so here the important words are branch, account. I'm going to use the pointer better. Okay, so the keywords or the vocabulary words are account, branch, high street banks, current account, debit card, joint account, in the black, go into the red, overdraft, and rate. You probably understood the concepts just by reading. I recommend you to use a dictionary for definitions, no for translation. You can check on Oxford Dictionary for business, that's the best one. She says that she also has a deposit account or savings account. This is probably the ones we use the most here in Ecuador, savings account, for keeping money longer term. This account pays us interest, but not very much, especially after tax. They also have a credit card with the same bank too. Buying with plastic means buying with credit card. It's very convenient. We pay off what we spend each month, so we don't pay interest. The interest rate is even higher than for overdraft. Like many British people, we have mortgage, a loan to buy our house. Okay, important words here in the end. Deposit account, which is the same as savings account. Credit card, plastic, pay off, and mortgage. So in British English, you say current account or check account. In American English, you say checking account. So when you have a checking account, you can have checks, you can sign checks and give money on paper. Okay, so knowing this, you can read it again later. Anyway, you're going to receive this information on your emails. So you should read this and complete from number 1 to 8, okay? So read again and choose if it's true or false, and then you complete the numbers from 1 to 8. This is a homework. Now, new ways of banking. As you can see here in the picture, basically it's what we do right now. It's the way we are moving money, right? Cell phone to cell phone or computer to computer, by using some applications or some websites that let you pay online. So here is the case of Kevin. The other girl was Lisa. This is Kevin. He wasn't happy with his bank. There was always a queue. Queue is a line, but this is a British word for a line. When you make a line to buy something. So there was always a line, and on the bank statement that they sent each month, they took money out of my account for banking charges that they never explained. So I moved it to a bank that offers telephone banking. I can fund them anytime to check my account balance, the amount I have in my account. This is account balance, the amount money they have in an account. Transfer money to other accounts and pay bills. So it's like faster and easier. Now they also offer internet banking. I can manage my account sitting at my computer at home, exactly what we do right now. Okay? Good. Now, what about personal investing? This is Lisa again. Personal investing. Talking about the money you invest on yourself or the money that you handle by yourself. And Lisa says, we have a savings account at a building society, which is going to be demutualized. That's a very important word. And turn it into a bank with shareholders. All the members will get a windfall, a special once-only payment of some of the society's assets to its members. Okay, so everybody's going to receive some money for that. We have some unit trusts, shares in investment companies that put money from small investors like me into different companies. My cousin in the USA, in the United States, calls unit trust mutual funds. Mutual funds. So they go together. I also pay contributions into a private pension, which will give me a regular income when I stop working. I've never joined a company pension scheme, and the government state pension is very small. So what are the key words here? Building society, demutualized, windfall, unit trusts, investment companies, small investors, mutual funds, contributions, private pension, company pension scheme, and state pension. Okay, so we talk about three things today: traditional banking, new ways of banking or modern banking, and personal investing. So after seeing this, I want to share with you this video, which is basically a recommendation how you can save money, how you can handle your money. And this is the 50-20-30 rule, as you can read here. So if you have the chance, it would be really good if you watch this video with your parents, because they are who manage the money at home. So you can watch the video together and both can learn a lot how to manage your money better. And it's not because sometimes we don't know what to do first or something like that. It's because sometimes we confuse between what we need or what we want. This is something that we probably studied in entrepreneurship at a point. So let's watch this video and then enjoy. Remember to invite your parents to see it, or if you can't invite them, or if you don't want to, maybe you can talk to them about this later. It's going to be really useful for your home economy. Okay, here we go.
Managing your money using the 50-30-20 rule. Are you ready to watch your money grow this year? What if I told you there's a way you can exponentially grow your money this year? Would you be interested? Well, if you are, make sure you watch this entire video, because we will be talking about an amazing rule that will help you achieve your financial goals this year. Today, we're talking about the 50-30-20 budget rule. I know you've probably heard or maybe come across this rule before, and you might even know a thing or two about this rule. But in today's video, we will explain exactly what this budget rule means, how to use the rule, and what not to do so that you can meet your financial goals. The 50-30-20 rule happens to be one of the best and most popular tools for people who don't have time to track all their spending. But what an easy way to manage their expenditure, save money, and control their money. The rule works like this. It requires you to divide your expenditures into three categories: your needs, your wants, and savings or debt. But before we continue with the video, are you a subscriber? If not, please hit the subscribe button and the bell icon to get notified whenever we post. Now let's dive into the video. To help us illustrate this rule, I'd like you to say hello to John. John's an average guy who makes $4,500 a month after tax. Using the 50-30-20 rule, John will need to divide his money like this. 50% of his money, which is $2,250, will go into his needs. 30%, which is $1,350, will go into his wants, and 20%, which is $900, will go into his savings, or paying off debt. Just like John, you too will need to divide your income into those categories. Simple, right? But let's look at it a little closer. Step 1. Limit your needs. Needs are things you can't live without. These include things such as housing, health, transportation, utilities, food, paying off debt, and the bare minimum for clothing, shoes, and other living supplies. Only include items you can't survive without in this category. If you don't have a budget, this would be the ideal time to create one. Carefully analyze what you spend your salary on each month within this category. Warren and Tiagi, who are financial experts, say this category should not exceed 50% of your monthly income. If it does, then something is wrong. If you do, however, spend more than 50% of your paycheck on your needs, don't panic. All you need to do is carefully evaluate what you spend your money on each month. A good rule of thumb is to track your expenditure so you can have a good picture of where your money goes. Once you know where your money is going, adjust your needs by reducing unnecessary expenditures or find cheaper alternatives. Once your budget matches the 50% limit, you can now proceed to the next step. Step 2. Define wants. Now a whole 30% of your paycheck going towards your wants may sound like a whole lot of money, right? You may be picturing a nice pair of shoes, or that new iPhone that got released the other day. As nice as all those things are, we're not talking about buying your deepest desires. By wants, we mean expenses you can opt out of spending on, but your life would be harder without them. I'm not sure your life will be any harder without that new phone, but you might find it hard to communicate without a mobile data plan. This category should include things like your internet plan, data plans, home cable bills, mechanical, not cosmetic repairs to your car, and so on. I bet you now get it. Sometimes it may be hard to distinguish between needs and wants, but the rule of thumb when it comes to defining a want is by asking yourself if you can live without it. And if you can, then it's most likely a want. Now the final step. Step 3. Save up. The final 20% of your paycheck should go towards your savings and paying off debt if you have any. This money can be used as an emergency fund, a deposit for a home, for investing, or savings for retirement. If you feel as though that 20% isn't enough, you can transfer more money from your wants list into this account. Now let's talk about the types of debt that should be included in the 20% category. The only debt that should go into this category is that which is above the minimum required payment. For example, additional credit card payments or extra payments on mortgage to clear your debts faster should go into this category. The minimum payments on debt should definitely go towards the needs category. The reasoning behind this is that the minimum required payments are compulsory, and failure to pay them would cause adverse effects on your credit status, something you just can't live with. The 50-30-20 rule is great because it helps you track your expenditure easily. Having just 3 categories creates a structure that is easy to follow and helps one to focus and manage money better. It's less detailed, making it ideal for individuals who have busy lifestyles and minimal time available in a day. The rule works really well for people within the lower income brackets, between $100 and $6,000. It's however not ideal for high income earners because they would be forced to spend unnecessary money on needs. The 50-30-20 rule has helped many people get their finances on track. So many financial experts swear by this rule. Many people who have been in horrible financial ruts have made it through by following this guide accordingly. You can be one of them if you apply it today.
Okay, that's a really good video because you can learn a lot. Watch it again, please. And one more time, if you have the chance, show it or talk about this to your parents. I'm sure they will appreciate it. Okay, as you can see here in the picture, basically, spend only 50% of the money you earn on needs, things you can't live without, like food, shelter, medicines, etc. So needs, things you really need. Only 30% on wants, things you don't need but you want. For example, a new cell phone or new clothes. Okay, it's something that you want. So not much, only 30%. And save 20% for an emergency or for studies or for something really important. Okay? Good. Let's continue. And this is going to be your homework. I decided to put it in the end because it has something to do with the video. So you have to match the sentences 1, 2, 3 with the correct endings A, B, and C. This is about vocabulary, the one we just read in part C. So that's it. I really appreciate your attention. Thank you very much. Have a wonderful day and see you next week, everybody. Bye-bye.